Well, dang. Hello, this is Rex Crandell, and today we're going to be talking about Schedule C. Schedule C is part of a tax return for small business owners. Its purpose is to report your income and expenses so you can get your net income, and then you can determine how much tax you have to pay. It's filed along with the IRS Form 1040. And like the rest of the tax return, it's due April 15th each year if you don't have an extension of time to file. So who must use this form? Anybody who has income from self-employment. You have your own company, you have your own little business. Sometimes it's called a side gig. There are a lot of different ways that you can find out you need to file a Schedule C. Taxable income is when you're providing services or selling products, that ends up being taxable income. If you're receiving a loan or transferring funds in your bank account, that's not income. And the idea is you want to keep track of your expenses so that you can pay the least amount of income tax possible. We're going to cover a lot of different types of expenses and how to report them in the formatting for vehicles, depreciation, business operating expense, home office, allocation between business and personal. And the idea is to keep yourself out of trouble from the Internal Revenue Service and the California Franchise Tax Board. Before you get started preparing your Schedule C, you're going to have your bookkeeping up to date. So take your QuickBooks accounting report showing all your income and expenses during the year, run a profit and loss or income statement for the year, and check the box that says cash basis, which you're only reporting the income received and the expenses you actually paid, rather than reporting income from just sending invoices. You should keep your bookkeeping up to date every month at the time you're doing your bank reconciliations. And accounting is fun, isn't it? Some people think so. This is the culprit, profit or loss from business. So it's IRS Form 1040 Schedule C. We have what year it is, 23, 24. The heading, income section, expenses. And then we have a page 2, which will cover backside of it. So we will go through each of these in detail. And we have multi-member LLCs that are not reported here. We'll get into all the fun parts. We have worksheets for auto, for depreciation, for machinery and equipment, and then other expenses. This is the section on the home office that we'll cover. Home office means you're working out of your home for business. And then we'll talk about self-employment tax, which is another tax upon the net income in addition to the regular income tax. We'll cover the section for product sales. This is a minor section for automobile. And then we list the various expenses here on page 2. So self-employment comes with many perks, meaning you can write off a lot more than you can if you're an employee. Employees in a W-2, you cannot write off very much at all expenses for generating income. At first, the Schedule C might seem daunting. It is 48 lines, but nobody fills out all of them. You just have to fill out the ones that are necessary for your situation. The full name is Schedule C, profit or loss from business, sole proprietorship. It calculates business net income for taxability, and then all the details get integrated into your regular tax bracket. People who file this return are required to are sole proprietors and single member LLCs, which limited liability companies with only one member or owner. And you fill one out every year that you have taxable income above $400. And then you attach it to your IRS Form 1040. Okay, so sole proprietorship, what that means is perhaps you filed a fictitious business name in the county or you're doing business under your name. And in that case, you do not have a separate business entity. You're not an S corporation or a C corporation. The business entity is you and you are the business entity. And you start out with your social security number. Um, Side gigs is also a sole proprietorship. All that means is perhaps you have another W-2 income. Single member LLCs, limited liability companies. What happens in this area is the IRS has determined that if it's only one owner or member, shareholders or own corporations, members own LLCs. If there's only one person, the IRS does not want a separate tax return. You just put that income right in the Schedule C, unless you're running rental properties with an LLC. And then you would put the income into Schedule E as an echo. But we're talking about Schedule C as in Charlie at this point. By disregard, it means federal doesn't want to see a separate tax return, so don't bother. Unlike a multi-member LLC, more than one owner, or a corporation, they both have to file separate federal tax returns. California goes along with the idea of of the LLC being somewhat disregarded, but they've come up with another form called the 568 form, and they want you to fill this out separately, even if there's only one member, because they want to make sure you pay that $800 each year. And then when your income gets above 250,000, you have an additional tax above the 800, which is 1.2% of your net income. And most of the questions on the California 568 have to do with you answer a certain way and you get an opportunity to pay more tax. So there's another term you see in this area is called single member limited liability or SMLLC. If you're married and you're running a business together, you can elect to be treated as a single member, and then you don't have to file the separate tax return on federal. There is a caveat there. If you're married, I do suggest you break the Schedule C in half the income from one spouse, half the income on the other spouse into two Schedule Cs, so that both spouses can contribute every year to their own Social Security account through the vehicle of Schedule SE, as in Sierra Echo. Because if you put both spouses on one Schedule C, only one spouse's Social Security number shows, and the other spouse does not get to build up their Social Security account. It is recommended that you might want to try to avoid using Schedule C, like a multi-member LLC or an S Corp. And the purpose of not using the Schedule C is that the IRS will let any trainee or any auditor handle an audit of a Schedule C. However, when you have a multi-member LLC or you have an S Corp or a C Corp, the IRS has to have more highly trained individuals, so there are less of them. And as a result, the business entities end up with a lower percentage overall of IRS and state audits. So as we mentioned, the LLC, if you're operating under that, if you're a legal document assistant, you will not be operating under that, but the entities have a $800 annual fee to the Franchise Tax Board, and then you have an additional tax of 1.2% of gross sales above 250,000 of sales. What information is needed? Well, you got to put your social security number on it. That's true. However, I recommend that you get a taxpayer identification number, even for a sole proprietorship, so that when somebody wants you to fill out an I-9 or wants to give you a Form 1099 NEC to show your income, you can give them your taxpayer identification number instead, so that they don't have your social security number. And if you're a non-resident alien, you can fill out a form and get what's called an ITIN, individual taxpayer identification number. Even though it doesn't give you the right and ability to work in the United States, it would give you a method of reporting it on the tax returns. Next line, you're going to list what kind of business are you in or profession. IRS uses the kind of business that you're in to kind of evaluate the reasonableness of your business expenses. The next box on the top of the Schedule C is for your North American Industry Classification System number, NAICS. This is a numeric system so that the government statisticians can track different effects within the economy and see how different industries are performing. You can look that number up at the www.census.gov NAICS. And I've never seen any problems on audits with any of that. If somebody made a mistake, just do the best you can for the kind of business that you are in. Well, speak of the devil, there's Schedule C right in front of us. So name, your social, your type of business, and your industry classification code we just talked about, the business name that you're using. If you filed a fictitious business name with the county and advertised it, you would list that here. And then your employer identification number, which I have already suggested you get. List your business address, where you operate your business. Especially for women operating a business, I suggest getting a street address, like a UPS store, a FedEx, so that you're not publishing your personal residence on the internet with your marketing and other materials. What kind of accounting method do you use? There's cash basis. When the cash register rings, then you have a sale. When you pay a bill or charge someone a credit card, then you have an expense. The other method for accounting is accrual. And that means that when you send an invoice, it's income. When you get a bill from a vendor, that's an expense. And all of the large corporations on the stock exchanges use the accrual method. However, virtually all small businesses that I work with use the cash method. And besides, you don't want to be paying income tax on invoices that you sent and you haven't even gotten paid yet. Next question has to do with, did you materially participate in this operation? Yes or no? What this is for is they are trying to find a situation where somebody has a lot of money. They start a business, they never show up, they don't work in it, they hire everybody, And the government frowns on them taking losses if they don't have any skin in the game. So that's what material participation means. If you started the business this year, you check the box, and then they're going to be looking for an expense category called pre-opening expenses that we'll talk about. You don't write them off currently. You capitalize them on the depreciation schedule and then amortize those expenses over 5 years. That's under section 195. Did you make payments that you would require you to issue a 1099 NEC? So if you hired independent contractors, which I don't recommend, and you paid them over $600, you have another filing requirement to issue them 1099s. And the cover sheet, when you file those, is a 1098. And then you have to answer if you did have payments for independent, did you fill out the file forms, the proper forms or not under penalty of intimidation? So we're going to look at some of the expense categories here. We've already talked about the top lines: business address, methods of accounting, accrual and cash, and the material participation. That just basically can limit your losses if you don't work in it. If you did start the business during the year, you can write off up to 5,000 of startup expenses before the business was open. The rule is if, like, say you're building out a shopping center store, and during the whole time of construction, you do not get to write off your expenses. All those expenses are pre-opening expenses that you will capitalize and amortize over 5 years, or if they're larger structural, then it could be 15 years of the expense you claim to recover your cost. We talked about the 1099 NEC and whether you're filled the forms out or not. So now we're in the income section. Gross income's line 1. Total sales. One thing I recommend that if you are you transfer money between bank accounts, that you always show it as a transfer of funds, because the IRS on every small business audit takes all your bank statements and they take every one of your deposits and they call it income. And then they make you prove that it was not income. So a simple transfer of funds from savings to checking would trigger the IRS to say that's income unless you can prove otherwise. That's not a good thing to have to pay tax on your transfers of funds. Returns and allowances. This means basically that you gave money back, or that on a retail business, people turned in items and got their money back. Cost of goods sold. If you're in a product business, we'll cover that soon on page 2. And then after your cost of products sold, and does not apply to service businesses, then you get your gross profit. Gives you a section on other income, line 6, that doesn't fit in the other categories. So if you're in the product business, buying and selling wholesale or retail, you will be using this section called cost of goods sold. So in accounting school, we had a little jingle: beginning inventory plus purchases less ending inventory equals cost of goods sold. And that's how the form is built up. So we determine what method. There's several different methods to count your inventory. costs, lower costs or market. I'm not going to go into great detail there. But generally, you take your beginning inventory at cost, not at retail. Then the purchases you bought to add to your inventory at cost, adding labor, adding materials and supplies, and that gets your inventory available for sale on line 40. And then you subtract your ending inventory at cost, and lo and behold, you get your cost of goods sold. And from that point, that it's an expense, a disbursement, you go back to the income section and you put on line 4 the cost of goods sold. Not a difficult computation. Now, we're going to get into expenses. In order, what is considered a business expense, the IRS uses a phrase, ordinary and necessary. Is it normal for your kind of business to buy this stuff? If it's not normal, then it may not be deductible. They use a term called lavish and extravagant. That's one thing that they don't want you to deduct when you overbuy things that are outrageously sophisticated or expensive. And it has to be directly related to the creation of income. So if you hire a babysitter, so you're a parent of a young child, it is necessary, but it's not necessary for tax purposes for the business. So you cannot write off babysitters for your kids. And would the business seem reasonable if you asked a third party? Do they think a business would be writing off something like that? If the expense had part business benefit, but also part personal benefit, then you have to allocate and split the cost between business, you can write off, and personal, you cannot. For example, if you work out of your house and you have internet and you use it for business and personal, then you would allocate it based on the time spent in each area. And if you want to know whether an expense is a reasonable business expense, I have a test called the straight face test. If you tell the person, someone else, what you bought, and you cannot say it with a straight face, so you're laughing about the ridiculous thing you bought, then it's probably not a business expense. Now, we get into the expense section. Okay. So this still is on page 1 of the Schedule C. We have a lot of different categories, advertising, insurance, pensions, repairs, and we'll go down through those sections. Advertising, you just list the costs, commissions and fees paid. And line 9 here starts off with auto and truck expenses. See instructions that will confuse the heck out of you. So you can take your mileage or you got to write off your car. You need it for business, okay, in this hypothetical. So you can write it off in 2 methods or 2 different alternatives. One way is you can take your mileage or estimate your mileage. Let's say you drive 30,000 miles a year and you've done a calculation, let's say for 3 weeks, and you know that on the average you drive 2/3 of your miles for business and 1/3 for personal. You take that 3-year test and extrapolate it out for the year, and that's your ratio between business and personal expenses. And what we're trying to do here is find out for those business miles that you drove for 2024, you can write off 67 cents a mile, and you don't have to show any other records. You don't keep your gas receipts, your repairs. It includes gas, oil, repairs, and maintenance when you use the standard mileage rate. So it's a simple way to do the auto expense. The other way to do the auto expense is actual operating expense. So in this example, you keep track of gas, oil, repairs, maintenance, insurance, vehicle registration, and then you take that ratio that I discussed before, 2/3 business, for example, 1/3 personal, and then you cut down all those total expenses down to their business use component. And I have an example here on coming up with your mileage ratio, your business use ratio. So in this example, we have 13,000 miles, total miles driven, 28,000, 13 for business. We have 46% business use miles. So with that, those business miles of 28,000, you can use the per mile optional method at 67 cents a mile, write that off, or you can calculate through a ratio. We call this the actual cost method. And in this method, you keep track of all what you paid for the vehicle. And what we do is we take the mileage method, see what it comes out as. We do the actual cost method and see what that expense works out at. And then we take the higher of the two computational methods, and that is appropriate. So in this example, we have 100% for gas, insurance, license, interest on the loan, and we have the business use percentage, and then in the right column is what's left over that would be deductible as business use of that vehicle. Okay, so this shows the computation of the two methods. And in this example, we had 5,688 of actual costs for the business use. And then we did the standard mileage rate. And lo and behold, we got more deduction. We got 10,265. So which expense do you want? 5,600 or 10,000? Well, I want the 10,000, and that's what I would recommend you use. This is the, just for example purposes, the entire auto expense worksheet with the mileage, the allocation, and then which method you selected. Okay. So lease versus buy, there's two different ways. I mean, you can buy a car or you can lease a car. It would take me too long to explain the lease method, but basically there's no depreciation. You write off your lease payments based on your business use percentage. And the only thing you cannot use the mileage method when you're leasing because you don't even own it. But you would still use that computation of all the costs for the vehicle, gas, oil, repairs, maintenance, insurance, times your business use percent to come up with the deductible component. So there are online calculators where you can do lease versus buy comparisons. When you buy the vehicle, you end up putting it on your depreciation schedule, and then you write it off ratably, say, for example, over 5 years. Maybe it costs 40,000, but then you only take 20% of it every year. I generally don't like the leasing as much. One of the reasons I think is when you buy a car and you get a loan, they have to give you the annual percentage rate, the APR, so you know how much interest you're paying. And when you get a lease, they don't have to tell you diddly. And so oftentimes the cost to lease ends up being higher overall for the use of the vehicle. So there's what methods you can use for tracking your mileage. You can log it on QuickBooks. There's other, have a log in your car. Several years back, IRS told everybody you got to keep a log every time you drive your car in order to write it off. They couldn't get people to do it. I mean, you're not going to be writing that down every time you go for a drive for business or personal. So that's why I suggest the 2 or 3 week method. Do that detail for that period of time and then project it for the entire year. When you use the per mile optional method, the standard rate at 67 cents a mile for 2024, there's a factor that builds into it for depreciation. If you were to sell the car, you would take the original cost less this depreciation based on the mileage, and then compare that net number with what you sold it for to determine if you had a gain or loss on the sale of that vehicle. Contract labor, independent contractors. Now, virtually every small business owner I've ever worked with comes in and says the same thing. Well, we decided we're not going to hire employees with all that paperwork. We're just going to have independent contractors. Yeah, that's what we're going to do. Issue them a 1099 NEC. That's a common thing. I don't recommend it at all. I do not recommend hiring independent contractors because there's a pitfall. And that is when the business is audited and they find out about all the independent contractors, then the IRS or the Employment Development Department frequently reclassify those independents and they call them employees. And when they call them employees, they zing the employer for all the payroll taxes they should have withheld, plus all the payroll taxes the employer had a responsibility withhold for themselves. And then they assess penalties on top of it. And they can go back 3 years with that little dastardly trick. And it is super expensive in terms of penalties and fines and things. Another thing, you have to have workers' comp insurance for every employee. And if you hire somebody as an independent contractor and they're really an employee working at your premises with your tools on your direction and control, then you're supposed to have workers' comp for each person. If you don't, that could be a $1,500 fine. And then people say, well, I think I can get away with it. And then what happens is your independent contractor who you knew was independent, they agreed they were independent, and then they decide not to work for you anymore for whatever reason. They go down to unemployment department and file for unemployment, and they say, who was your last employer? He was my last employer. Now you've got them going against you with the EDD on their side, wanting to assess you back wages and penalties. It's not a pretty sight. So just do the payroll and get a payroll company to handle the payroll reports and things. Guptos One, ADP, a lot of different ones, paychecks. Do it the right way and you'll sleep a lot better at night. Depreciation expense. Yeah, like I said, you buy things and you can write them off over a period of years. A vehicle maybe over 5 years. You buy a building, you might be able to write that off over 27 and a half years or 32 years. And then there's this other type of depreciation called Section 179. And that expense, you claim a large amount right in 1 year so that it doesn't drag out over several years. And they keep raising the maximum amount, so they actually make depreciation schedules ridiculous in the fact that you can write off up to $1.2 million of business assets other than real estate. So there's all these depreciation laws and rules and levels and percentages, and they're all worthless because of this Section 179. And they've got another one called bonus depreciation. So you just follow the formalities, put the item on your depreciation schedule, and then write it off. This is an example of a depreciation schedule. So we're listing trucks, equipment, how much we're going to be writing off, how much we wrote off in prior years, what are we writing off this year, and then you bring the current year depreciation forward to your Schedule C in the auto section. Here's depreciation, line 13. So all the computers do it for you. It's not something you'd be cranking out. Okay, employee benefit plans. If you have a simple plan for employer or SEP, self-directed IRAs, then you would write off the expense that the employer paid on that. Depreciation, insurance. So that's pretty straightforward. We have insurance. It says other than health, I would not put auto insurance. I would put it up in the auto worksheet. Interest expense, legal and professional services, office expense. There's the pensions. Rent on business property is separate from rent on vehicles and machinery. The deductible part of meals, which is only half, and then a list of other expenses. So some of the examples of pensions that companies might have, SEP, those are pretty good in higher income. You can write off up to $55,000 a year. The simple plan, it's more reasonable for the small business. There, 401k, which you've heard about. When you get a higher amount in those plans, you have some other reports that you have to report to the government because if you're managing the money, it's not the company's money. It really belongs to the employees. Rent or lease, vehicles and equipment go on one line. Other business property expense goes on another line. Repairs, other than car, I put all the car on one sheet. Other types of repairs like on building or equipment. Then supplies, those are things that are going to be used up within a year. So if you buy a new computer or a printer or a copier, that's not a supply because hopefully that little puppy is going to last longer than a year. So, supplies would be pencils, paper clips, little things that at the end of the year, you don't expect them to be there anymore. Tax and license. There's no limit to the kinds of taxes there are in the world. So you would list just tax and license, not payroll taxes there. You would include payroll taxes in with the cost of the payroll. I've seen people, it's kind of rare, but they'll take the sales tax off and try to write up, forget it. Just put the whole thing under tax and license, whatever you bought. Okay, so we're moving along at lightning speed here. So we're in travel and meals, that's line 24. It used to be travel and entertainment. You notice the word is glaringly not there. Well, you cannot write off entertainment anymore, so don't even try. But travel for business, you can write off, and meals, you can write off half of them. Assuming it's business related, not your personal meals with family and friends. So travel, that would be your going out of town. You can't get back to home to sleep in your own bed. You have to rent a hotel. You have to buy meals. The transportation cost is the travel. It would include other things, lodging, business calls, tips for taxis, Uber. So travel, if the purpose of the travel was business. If you go on a vacation and you make a couple of business calls, forget it. That's a personal trip. Don't write it off. And I suggest being honest and truthful on all of your transactions and tax reporting. Honesty is the glue that holds our entire country together. And I don't see any reason at all to put phony stuff or exaggerations in a tax return. Do it right and you'll sleep better and not have to worry. Meals. Well, you can only write off half of those business meals for business. There are some other types. Normally you write off the actual cost, who you entertained, keep receipts. Then you can write off half the meals, except when you're traveling on business. There's another method where it's called the per diem rate. It comes from a government chart. You can use it. It gives you so much a night for hotels, gives you so much average for costs for food. And I've given you the link there if you're curious about how that works. Here's some per diem amounts. For example, current reimbursements 2024, get up to $13 right off for breakfast. Wow. Doesn't seem like enough, up to $26 for meals, dinner. Anyway, it's just another way to get expenses and you don't have to do as much documentation. Utilities, all kinds of utilities that you have, electricity, gas, trash, heating, internet, cable. Just remember, if it's combination business and personal, you need to reduce the expense by the personal component. Wages. So under the wages category, where are we at here? Employee wages, line 26. Where was that here? Too far. Wages. So you put the salaries and wages, the employee benefit costs, the payroll taxes and bonuses and commission under that expense category. Other expenses. Now, this is on the back of page 2 of 1040 Schedule C. And if you didn't like any of the categories that they used in the form, you can make up your own categories and just list them here and then bring them forward as expenses. For example, I would recommend not using contract labor as an expense category because of the reclassification to employees I mentioned earlier. I would probably put it in this section. So we hired a gardener, we hired a painter, something like that, where it doesn't show it so much as potential employee costs. And the other expenses get brought forward to line 27 alpha. Now, moving right along, this energy efficient commercial buildings, never seen it in my life, probably never will. Total expenses and tentative profit. Okay, that's the way the form is designed. And the reason for that is they want to try to clip your expenses. You get income and expenses, okay? But you have to leave your home office expense out of that computation because we're going to do the home office expense in a second. So the home office expense, there's a couple ways to do it. One way is the simplified method. So see, you're working out of your house, you have 300 square feet of exclusive business use area, and you can write off $5 a square foot without a whole lot of computations and bring that forward to the expense section of the tax return. So it's a different form here. It's a simple way to do it. The other way is to take, there's a worksheet which I'll show you. You take all your expenses, break it down by the personal use, and reduce the expense, and then deduct the rest. So home office expenses, if you have home office expense and it is going to cause your business to show as a loss, you cannot claim the full amount of the home office expense this year. It's limited to zero net income on your business. And the amount you did not get to write off this year, you can carry forward it to next year. So I've included a chart in your material on the two different methods, the simplified $5 a square foot to a maximum of 300 square feet versus the details on the regular method of home office computations. Now, there is an official home office expense schedule for those of you who like detail. It's IRS Form 8829, and it feeds right back to your favorite Schedule C. So what you do is you put the area that's all business, 300 square feet. Let's say the total area of the home's 2,000 square feet. So we know 15% of that whole home is business. So using Form 8829 to get your business expenses, it shows they want to see what the net income is, then what indirect expenses means you need to allocate them between business and personal. So you go through the computations and you find out what the business use percentage is. And then if you have a net income to offset these home office expenses, you can claim them as an expense this year. And the bottom of the tax return, the Schedule C, ends up limiting the expenses for the home office. So that's why before we were talking about, total income, total expenses, what's your tentative profit before home office. So if you use the simplified method and you have 300 square feet exclusive business use, then you get to write off $1,500, assuming you have more than $1,500 of income, taxable income. Then you get to net profit. And drum roll, we're at the net profit. And you take that net profit and you bring it into your taxable income with all your other income, and you get to tax it once there. Now, after you tax it once there, you get to tax it another place. You get to tax it as self-employment income. And there's a Schedule SE. It's 15.3% of your net income gets taxed on Schedule SE for self-employment. And that is an additional tax onto your regular tax bracket. Well, first of all, you say, oh, I don't like that. Oh, it's horrible. I got two taxes. Well, it's not as bad as you think, because it goes into your own Social Security account for the future when you retire. But you do have to pay it now. So when you get down to this level, you get into Schedule SE for self-employment tax, and there's a maximum amount you have to pay if you're real high income groups. They break it down into percentages. I won't go through into all the nitty gritty details, but it ends up being 15.3% of your net income. And like I say, it goes into your Social Security account. And in this case, you had 12,000 of self-employment tax. They give you a little bonus deduction. Half of that amount you can claim as a business, it's an adjustment to your taxable income. And if you don't have any net income and you want to build up for Social Security, on that Schedule E, there's a section on page 2 where there's a per mile optional method, and you can get pay a little bit extra, maybe 400 or so, and you end up essentially buying 4/4 of qualification for Social Security. So if somebody was working or not working and they need to, in order to get Social Security, you need to have 40 quarters or 10 years of work. If you use the per mile optional method, the optional self-employment tax method, you add 4/4 each year to your qualifications. At risk, these laws came into effect where rich people were putting money in businesses and having loans they're not responsible for. And if you have a loss, you have to compute how much you really can lose, how much investment you have in the business, and especially if you're not working in it, it's how much skin you have in the game that you could lose. And there's a form when you get into that world, 6198, that calculates your losses, how much your basis in the investment is, and whether you can write it off or you have to carry it forward. Way beyond the scope of today's discussion. And today we covered what is a Schedule C, who must file the form, what kind of stuff do you put on a Schedule C? Uh, can you deduct the maximum amount so you pay less? It's the pre-enterprise system in action, and you're the boss. Um, Types of expenses we covered: vehicle, depreciation, business operating expense, home office, allocation between business and personal losses. So report all your income and expenses accurately, keep good receipts, keep your books up to date, and if you get audited, after you get over a heart attack, you'll probably come out okay on the audit, um, especially if everything is the way it should be. So now you know everything you need to know about Schedule C on the IRS Form 1040. So with that knowledge, go out and conquer.